My name is Sue McCracken. I'm Associate Dean Academic at the DeGroote School of Business, and I would really like to welcome everyone and thank you for being part of another Knowledge Labs webinar hosted by the DeGroote School of Business. These webinars have been hugely successful, and we're really excited to have all of you with us today. This webinar is hosted in partnership with Manulife Financial and the McMaster Alumni Association, and we thank them for their partnership for today's Knowledge Labs webinar. The registration, as I said, it's huge. We're really pleased to have such a large number of you joining us today. It will be recorded and will be shared afterwards as well. But thank you so much for joining us. Through our Central Alumni Partnership, we have alumni from every faculty, and it's really evenly distributed between all of the faculties. So very exciting to be bringing all of McMaster together. And it obviously shows that everyone is interested in today's topic. So I'm looking forward to learning about today's topic as well. In addition, we have people joining us from all over the world. We have the US, Scotland, Saudi Arabia, Hong Kong, and Oman. So welcome to everyone. And again, thank you for choosing to be with us today. McMaster and DeGroote, very exciting. Our DeGroote faculty, alumni, and ambassadors have a depth of research and industry knowledge, and that they're making available through these knowledge labs that we're sharing with you. Much of their work is focused on disruption in business, which is very relevant right now in the midst of this pandemic. This series is available, as I said, we do video it, record it, but it's available through a variety of channels, web articles, webinars, and in our In the Know video playlist. So feel free to peruse and look up past activities that we've had and our future activities as well. A couple of announcements for you. I'm very, very pleased to announce that we have a partnership with MyTax. It's a nonprofit research and training program to launch a business strategy internship program, which will support businesses of any size for up to 4 months. You'll see the slide on the screen now about it. It's starting this June, and it will cover 75% of the cost of a DeGroote intern undertaking a strategic analysis and helping restore or modify business operations for an SME experiencing COVID-19 disruptions. So if you are a business or nonprofit interested in learning more about this program, and we encourage you, if you think this might be something that would work for you, we cover 75% of the cost for a $10,000 internship. So it's $2,500 for the small business or the nonprofit, getting worth $10,000 worth of student time, internship time. So we're very, very close to the deadline, but if you are interested and you think this might work for you, for your organization, you'll see the email address for Cynthia Bishop on the bottom of this slide. Please contact her and we can get a proposal put together, and you can be part of this amazing opportunity for businesses in our area. I also would like to share with you an ongoing partnership that DeGroote has started with business communities, the Hamilton Chamber of Commerce and the Burlington Chamber of Commerce. This partnership is intended to support local businesses during these challenging times, and features a web portal for community members to access and submit questions to DeGroote faculty members and experts. Using this portal, we are doing our best to share expertise and advisement that will support businesses in our area as they navigate through these difficult times. So a great opportunity as well. So if you have questions about your business and would like some advice from our faculty, please, you see the link on the slide right now. Access that and the Ask an Expert, and you can get some help with some of your problems. I would now like to, so now moving on to what we're here, the main event for the day, I would like to introduce our speaker today, Phillip Peterson, who has kindly agreed to participate in the discussion with us today. So thank you so much, Phillip, for taking time to be with us today. We're all looking forward to it. As Chief Investment Strategist and Head of Capital Markets Research, Phillip has a range of investment strategy responsibilities, from market and economic analysis to investor education. Phillip analyzes and interprets the economy and markets on behalf of Manulife Investment Management and works with the portfolio management teams to provide clients and investment intermediaries with guidance and commentary on strategies and asset allocation weightings. We're very proud. Phillip is a graduate of our commerce program. And as I said earlier, we are thrilled to have Phillip with us here today. So we're really looking forward to hearing your insights on today's topic. And again, thanks for being with us. I also would like to introduce Ron Balvers, who will be our moderator today. Ron is a professor of finance and economics for the DeGroote School of Business. His area of expertise is asset pricing and financial markets and investments. Dr. Balvers holds the Michael Lee Chin and Family Chair in Investment and Portfolio Management here at DeGroote. So thank you, Ron, and thank you, Phillip. We're looking forward to today's session. So Ron, I'm going to turn it over to you to moderate. And again, look forward to learning some good stuff today. So off to you, Ron.
Okay, thank you very much, Sue. Welcome, everyone, to this session. I'm going to start out talking a little bit about some housekeeping issues very quickly. First one is there is going to be a question and answer session towards the latter part of the hour. And if you want to ask a question, please use the Q&A function part of this seminar, part of this webinar. Then keep in mind that these proceedings are going to be recorded. And if you participate with a question, then that implies that you consent to actually being videotaped or that your name is mentioned if you add your name to the question. So, you know, if you decide to participate, you have an implicit implication that you're going to be potentially part of this video. Third issue is we will, after this webinar, you will receive an email, and please answer the questions there. It'll take you a minute or so, and this will help us to improve the webinars as we go forward, and is a way of having continuous improvement on this series. Okay, now, so let's get going on the main issue. We're going to talk about money matters in the post-COVID world. And here's my first question to Phillip. Dealing with a general policy issue, you know, given the situation, and we're in a recession right now, pretty obviously, and question is, what can policymakers do about this, and what do you think policymakers will do about this? Now we have this monetary policy option, and it almost looks like we've run out of options there. And anyway, the situation is very different than it's been in the past. And so if that doesn't work, then are we going to have to rely on fiscal stimulus to try to get out of this recession?
First, Ron, let me thank you and Sue and everyone that's been involved in putting this webinar together. I feel honored to speak to you and everyone on the line, especially so being a MAC alumni, so this is very special for me. In regards to this recessionary environment that we're in and what we're seeing in the United States and around the world, it is very unique. It's very different. The way we describe it is that this is a sudden stop, or we're calling it the Great Pause. And it's been a recessionary environment that's been engineered by governments around the world. Most recessions come about because there's some type of bubble in the environment, whether it be an asset bubble, manufacturing bubble, capacity bubble, and so on. That wasn't the case here. The impetus for this recessionary environment was a sudden stop to the Canadian economy, the US economy, and economies around the world. So with that in mind, if it is a government mandated pause in economic activity, then it has to be a government mandated support along that pause and into the recovery. So I would applaud the Canadian government for what it has done to support those unemployed, the businesses that have been displaced. The solutions aren't perfect, nor do I believe that they're finite. I think that we will continue to see more come along. I think the question that we're starting to ask now is that as we start to see the case numbers spike in the United States, there's a resistance for states to shut down their economies again. And this could be, the great trade-off. What do we sacrifice, the healthcare system or the economy? if we look at Sweden as an example, Sweden said, we're going to keep the economy going, we're going to promote social distancing, but we're not going to shut down because they're accepting the inevitability or their belief that it's inevitable that everyone is going to get COVID, and they're going to move as quickly as they can to herd immunity. So back to the question in terms of what we can do. We've seen unprecedented amounts of fiscal stimulus in Canada and in the United States. We figure the U.S. deficit to GDP this year is going to be 20 to 25%, upwards of potentially $10 trillion. So quite meaningful. At the same time, the Federal Reserve in the United States has unleashed unprecedented monetary stimulus. It has expanded its balance sheet into the trillions of dollars. It's through special purpose vehicles. It has been buying bonds and so on. The Fed has done a very good job. The government has done a good job. Is it the be all and end all? No. I think now the message from the central banks is that the next response has to be fiscal, right? It has to be the continued government support. I think that's the right solution for the short term, but there are long-term consequences to that, and we can't just ignore those. And so we don't know what ultimately the outcome is going to be. But right now, I think governments have to do whatever they can to support the economies that they've effectively shuttered.
So Phillip, in terms of what sort of fiscal policy stimulus then would help the most? In my view, it seems like one issue is lending to individuals, and to some extent, that's a central bank issue, but it requires the support of the government so that banks are going to be willing to take on loans that by nature these days are much riskier. Mm-hmm. And I feel like that maybe ought to be the most important part of the help that the fiscal part of government provides.
I agree. I mean, if you consider the numbers of small businesses that have been greatly impacted by the shutdown, yes, we're starting to open up, but I don't think that the foot traffic is going to be as great as it was before. So the solution, I think, Ron, you have it right, that governments have to continue to provide some type of incentive, and whether this is government loan guarantees, if it's just outright grants, if it's tax incentives, that they need to provide something to allow businesses to get back on their feet. And it's not going to be overnight. We're estimating that a full recovery from here is going to take upwards of 18 months to get back to where we were, say, January and February. And that's just because you have to rebuild consumer confidence. You have to recapitalize the economy for what has been lost over the last 3 or 4 months. And so historically, what I've seen, and I would love your sense of it as well, but what I've seen is one of the more effective ways for government to stimulate economies is actually through tax cuts, less through direct government spending. Governments aren't always as efficient on the spending front as they should be. However, if they provide an incentive to business owners and consumers through tax cuts, then you tend to see the money supply turn over quicker. You tend to see confidence come back and in new investment come to the economy faster than if it's purely government sponsored through spending programs. So tax cuts and loan guarantees, I think, are two of the ways that I think the government should be considering supporting the economy in a recovery.
Yeah, that makes a lot of sense to me as well. I think that at the situation where the COVID epidemic seems to be over, we're now in a situation where all the fundamentals are still pretty much okay, but we're really in a pinch because a lot of firms will have accumulated debt, and in addition, we're not sure if demand is coming back. It's something like Tiff Macklem mentioned, that the supply will come back much more quickly than the demand will. And so the government may need to step in to try to stimulate demand. And tax cuts might be one very good way of doing that.
Exactly. Of course, it's difficult in this environment for the government to grasp the fact that they've just spent hundreds of billions of dollars on unemployment benefits and business benefits or support programs to say now we need to run a further deficit through tax cuts. But it historically that's the better approach to it.
That makes a lot of sense to me. So let me move things a little bit and talk about the more global level. We alluded to that a little bit already, but what's the impact of the pandemic? We've had this process of globalization and stronger integration. There've been a little bit of hitches along the way, partly because of Brexit and the Trump tariffs and maybe Xi Jinping's policies. But question is now with the pandemic, how has that affected the incentives towards globalization in a positive or in a negative direction?
Well, the immediate thought is that we're going to see an unwind of globalization in that the example that I often hear is, well, the Chinese factories, for example, were shut down in February. And so that impeded business in the US and Europe and so on. And therefore, if you actually repatriate the manufacturing capabilities, then you avoid those issues. Well, that didn't mean that COVID didn't work its way over to Europe and to the United States and shut down factories there. So the idea that a deglobalization or repatriation of manufacturing, onshoring of these capabilities is going to solve all the problems, I don't think that's the case. And at the same time, I don't think consumers are going to be completely willing to pay the prices or the increases in prices because of the labor market discrepancies, labor costs between, say, China and the United States, or Cambodia and the United States, and so on. I think what we're going to see, though, is a greater diversification of globalization, where companies won't solely be reliant on factories located in one area, one geographic area of China. They're going to be more diversified in terms of their supply chain. And so if they're going to be building in redundancies, I think is a good way to think about it, so that if one area is impacted because of something like the coronavirus or a natural disaster or some other type of shutdown, well, they can easily shift to another source as opposed to be solely dependent on one specific geographic region. And then there's also this other concept of nearshoring, where it's like, okay, we're going to have factories, the redundancies of our supply chains are going to be so that we're going to be closer to our larger markets. And it's not all going to be, if our largest market is in the US, then everything's going to be in China. It's like, no, we're going to split it between China and the United States, or Canada and Mexico. I think Canada and Mexico actually stand to be beneficiaries of this nearshoring or diversification of globalization that we could see happen. But the whole concept of, well, we're just going to reverse the globalization that we've enjoyed in terms of stable prices, lower inflation over the last 20 years, I don't think that's actually very likely unless we're willing to accept very rapid inflation to factor in the increased labor costs of solely manufacturing in the United States or Europe.
Yeah, that makes a lot of sense to me as well. I think and if you look at financial markets, I think in your perspective too, that there's going to be more diversification in terms of individual countries and in terms of how they produce and the supply lines. That probably also has an impact on the financial markets, where we have seen over time a very increasing degree of correlation between domestic and foreign stocks internationally, at least within the developed world. And it's very likely that in your view then that correlation over time will decrease, so that international diversification has more advantages.
Well, we certainly hope so. Otherwise asset allocation is just going to become a one-stop shop. Just pick a country and just stick with it over the next 20 years and you should be fine. But we think that correlations between markets come and go, right? Now, in this instance, this is a global pandemic, therefore it's having a global impact on companies and markets. Over time, we think that divergences in market opportunities will reassert themselves and the correlations will fall again.
So talking about financial markets, can we talk a little bit more about that? I think it's really a very important question for most of us, I think. What is the outlook over time of financial markets, and in particular, let's say the Canadian dollar and the stock market, relative to the United States, if we think maybe 2 to 3 years ahead?
Okay, so yeah, and the Canadian dollar has been a hot topic over the last couple of months. If we went back to the start of the coronavirus, there was some views out there that the Canadian dollar was going to weaken substantially because of the over-indebtedness of the Canadian consumer, the belief that the Canadian recession was going to be deeper and prolonged relative to that in the United States. We believe, and our work would suggest, that the Canadian dollar continues to be influenced by really two forces. Actually, right now, in the last 6 months, is really one force. It's oil prices. As much as we like to try and deny it over time, the Canadian dollar is a petro currency, and the correlation between the Canadian dollar and oil prices remains quite high. And we track this on a daily basis. And every once in a while you'll hear, well, the Canadian dollar is moving because of something the government did. Well, no, actually, if you just continue to plot it against oil, and it makes perfect sense. So we've seen the Canadian dollar move higher, and so I'll use it in the terms that many of my clients are familiar with. We've got 73.5 cents today to the U.S. dollar, or U.S. to the Canadian dollar, and we think it's going to trend higher. So it's moved up. Aside from the week to 10 days when oil prices went negative on April 20th, and then stayed in that $10 to $15 range for a couple days thereafter, Canadian dollar hasn't moved off of oil. So today, with oil at $37 a barrel US, using West Texas Intermediate as our benchmark, Canadian dollar is exactly where it should be, at 73.5 cents. We think, though, going forward over the next 6 to 12 months, that oil prices will continue to creep higher. So we've seen extensive production cuts out of OPEC plus Russia, Canada, and the United States that are going to shift the supply-demand fundamentals around oil from a glut to a deficit. Now, it's not going to happen immediately, but it's going to be a little bit more gradual. And so we do think that oil prices can nudge a little bit higher. Our target over the next 6 to 12 months is $45. Now, don't hold me to that. We've learned that trying to nail the price for oil is very, very difficult. What's a little bit easier is the trend. So we think the trend is higher, and so we're using 45 as our target, with the risk to the upside. And then, therefore, the Canadian dollar, the fair value for the Canadian dollar at that range is around 75 to 77 cents, with some risk to the upside there as well. Now, when we contrast that to the Canadian stock market, what I'm going to say might sound a little bit at odds with our view on the Canadian dollar, but we actually think the Canadian stock market, because of its makeup, can lag its global peers. Now, in a recovery, it should move higher. As oil prices move up, our stock market is highly correlated to oil prices as well. A little less so these days, but the banks remain correlated to oil, materials to oil. So our market is almost like a proxy on oil as an index. Individually, there are some fantastic companies that we can hold, but the market itself, because of its continued weighting towards energy materials and financials, we think it'll lag that of the United States and lag that of the international markets. And so when we think about our asset allocation, we actually favor U.S. and international, or global, think of it that way, over Canada. Canada has upside, and again, there are great companies to own in Canada, but when we look at the index level, we think it's likely to lag over the course of the next 12 to 18 months.
Well, it's interesting because I fully agree with all your arguments, but from my perspective, it almost goes the other way. I think, yeah, definitely oil prices are key for the Canadian exchange rate. And my perspective is, and prices did go down from $60 at the beginning of the year to now around 40 or even below, right? And so from that perspective, you might expect some improvement, but my issue is that a lot of the suppliers are going to be in the same position that everybody is in, which is large deficits and the need to come up with cash, right? And so we think Russia or OPEC countries, they will have a lot of incentive to keep production up in order to generate the revenue. And in that case, we would actually see the opposite effect. So
yeah, and that's what we saw in March, where OPEC refused to cut, and then Russia at that point said, "We're actually going to produce more. We're actually going to squeeze out the U.S. producer, the shale producers that have been a thorn in the global production side." The part of the challenge with that is that if you continue to produce a lot of oil, then the price is just going to fall, in which case it becomes a catch-22. Well, now I got to produce more oil to generate the revenue to be profitable. Saudi Arabia, for example, needs to meet their economic budget. They need $65 oil. That's Brent. Now, they're not going to get it if they just produce nonstop. So we often say, the best solution to low oil prices is low oil prices, because it kind of washes out production, where companies eventually say it's no longer profitable to produce. We're just going to shut down and wait. So we'll see. Ultimately, we've learned that oil markets are extremely difficult to predict. So I would say we can note this one, Ron, and come back in 12 months' time, and I'll owe you a steak dinner.
Yeah, there's a lot of game theoretical issues involved on what sort of games the power blocks play, and it's hard to predict, I think, in general. And now, if you look at the stock market, though, in your view, if oil prices do go up, then I would think that this is good news for the Canadian stock market, as you mentioned. And then relative to the U.S., I think the U.S. has been harder hit by COVID, and as a result, I think their earnings will suffer more, as we will see pretty soon. Show up pretty soon. And so from that perspective, I'd be more upbeat about Canadian stocks than U.S. stocks.
Well, I wouldn't necessarily disagree with that. One of the things that we consider is that, look, higher oil prices are good for the TSX, are good for energy producers, but they have to be at a level where you become profitable. And with the spread between Western Canadian Select and WTI still, at the wider level, when we talk about $45 oil for WTI, the Canadian producers aren't getting that price. So, I would be much more comfortable or enthusiastic on Canada if we had a view that we could get back to $65 a barrel, right? And I don't necessarily think that's the case. Now, you're absolutely right. Earnings in the United States on the S&P 500 are going to be awful for the second quarter. Our estimates are that we're going to see 25 to 35% decline in earnings or profits on a year-over-year basis. That will improve. Well, it's not going to be positive in Q3. It'll still be negative, but less negative in Q3. We'll see about Q4. I think the broad market is treating 2020 like a mulligan. Like, it doesn't matter. Earnings could drop 50%. It doesn't matter. What matters is, what does the recovery look like in 2021? And here, that's where I think we are looking towards, and I think the whole market, given the rally that we've seen off of the lows in March, I would argue the whole market is really thinking about that. There are nuances there are a lot of day traders mucking about out there and playing havoc with prices, but overall, the news couldn't get any worse. Like, we know we're expecting bad news. If we ended up losing another 10 million jobs in the United States for the month of June, I don't think the market would respond. I think it would just say, well, yeah, we know that. We're looking ahead to 2021. And so while you're absolutely right, earnings growth is going to be a real challenge, or it's going to be negative, just outright negative for the full year of 2020, it's what does 2021 look like? And we've started to build in a base case where by the end of 2021, company profits are back to where they were in 2019. So it is that gradual improvement. It is going to take from here 18 months out. Now, that's not factoring in the potential for a second economic wave of COVID. So whether we get a second wave of COVID, we'll see if that results in further shutdowns, or if economies are going to say, let's just keep going and we'll manage the healthcare system. But our base case is that 2021 does see a near or close to near recovery of profits, and similarly a near or close to near recovery in terms of economic growth.
Yeah, makes sense. Yeah, let me. We'll probably get back to this in a little bit, but I also wanted to spend some time to talk a little bit more about what's happening on the ground in terms of your experience at Manulife, right? And we've seen lots of changes in financial markets. For instance, we now have pretty near zero commissions on retail brokerage accounts, right? We also have seen in March, for instance, there were $14 billion in redemptions of mutual funds, right? And and in addition, so because of the pandemic, people are increasingly in need of information and advice on what to do. So from your perspective, how have things developed over the last few months, and where is that going?
Well, I'll say for myself and my team, we've never been busier. We're doing meetings like this, Zoom meetings, a number of these a day with our clients, with advisors that we work with across the country to provide the information that they're looking for. The challenge is that these markets have surprised everyone, right? And we would describe the markets or what we're seeing and what we could see over the next 18 months in terms of market activity in three phases. The first phase was kind of the panic phase, right? Where you mentioned 14 billion came out of equity or came out of mutual funds in the month of March, tragically near the bottom of the market. And so you have investors that locked in their losses. We saw the same thing in the United States, where over 100 billion came out of equity funds and balanced funds in the month of March. And it was centered around the low of the market. So investors, again, were locking in losses of 20 to 35% and have not returned. And so that's a challenge. What we emphasize is a balanced approach to investing. All the work that we've done over the years, going back 50 years of data plus, shows that a balanced portfolio that is rebalanced through market activity, meaning when you get a low like we saw in March, I'm not selling my equities. I'm actually shifting from bonds into equities to bring my equity weight up back to whatever my target is. If it's 60%, 50%, 70%, whatever that is, history has shown you see a faster recovery. And in fact, through a balanced portfolio, your returns are very similar to a 100% equity portfolio, but much less volatility. That's one of the key messages that we've been conveying. With the nuance that you also want to recognize the opportunity set in front of us when some stocks are mispriced, some indexes are mispriced, some bonds are mispriced, you take advantage of that. So asset allocation isn't static. And by asset allocation, I mean, so it's the diversification of your portfolio across stocks, bonds, gold, cash, whatever it might be. You don't on day one say, here's my asset allocation, great, I'm done, and walk away. What we do is we're always looking at the opportunity set over the coming 12 months. And we make shifts in our portfolio, always kind of moving towards it, right? When you sail with the wind, right? You're always trying to catch that wind, and that's what we're trying to do with asset allocation. And so coming into the coronavirus, we were actually underweight equity, not because we could have predicted the coronavirus, just because of where valuation was across the US, Canada, and international markets, and what we felt earnings growth was going to be. So we felt that there was a below average opportunity in equities, so be underweight. As we've shifted through, now we're starting to look at the markets even today and say, you know what, over the next 12 to 18 months, the market looks better now from a valuation, and pending an earnings recovery as well. And so we gradually start to increase that over time. So, but you're right, clients are looking for guidance. They're looking for help, especially given this rally that has come a lot stronger than what we thought it would, what most out there thought it would. And so it begs the question, okay, where the markets are up almost 40% today, notwithstanding it, up almost 40% off of the March 23rd low. Where are we going from here? We do think that we see, we believe we see positive upside over the course of the next 12 to 18 months. But again, we're looking in the mid to upper single digit range for equities. And then that varies by geography. I think the most important thing, coming back to what you highlighted in terms of Canadian mutual fund industry seeing redemptions of 14 billion, we're going to see volatility like this. I believe we're going to have continued volatility over the next 6 months until we are clearly in a recovery like we're seeing today. What we don't want to do is panic. Panic is a natural response to this, but it is to our detriment to panic. I was speaking with a client today that said, you know what, I just want to move it into GICs because I don't like what's going on in the market. Well, GICs today are going to pay you less than 1%, right? So I understand that we're averse to downside risk, but if I'm looking out 3 years, I have a strong confidence that we're going to make money. I have great confidence that markets will be higher and we will be solidly into the next business cycle in 3 years' time. And so that's some of the key advice that we're offering to our clients is we don't want to panic. Let's revisit our asset allocation. Let's take advantage of the opportunities, and let's, if we are longer term investors, let's stay longer term. And if we are shorter term, then yes, you should be in cash. If you need cash in the next 12 months, then you should not be in the markets today.
Yeah, so definitely liquidity issues are a good reason for redemption or withdrawing the funds. On the other hand, leaving your funds in now at a time where there's a lot of volatility, a lot of uncertainty, are also going to be a lot of mispricing opportunities, and you can benefit from solid advice.
Absolutely, and we've seen those. If you look at the price action of some of the companies, coming back to the TSX, where I said there's been some great opportunities. There's some fantastic companies listed on the TSX where their businesses in the United States or internationally, or domestically for that matter. I mean, Canadian Tire is one example. It's a stock that we followed and own, and look at what happened during the downturn, and it's recovered 50%. I mean, so there's been some fantastic opportunities to be had. I would love to say that you can time these things perfectly. You can't. March 23rd, the markets were down 11%. March 24th, they were up 10. Like that's just the volatility is crazy. But gradually looking at the opportunity set and shifting your portfolio towards that over time tends to pay rewards.
So let me ask one last question before we get into the Q&A section of the hour. We've had this big crash for a while, and after that, stocks have rebounded pretty dramatically, and now they're only a few percent below what they were at the beginning of the year. So is this the right way? Is this the way you would have expected the market to act, or was there just overreaction to the Q1 numbers that were fine, really relatively, and are the potential negative outcomes for Q2 and Q3 not properly taken into account yet?
I would say, this was the fastest bear market in history. And the rally has been one of the strongest that we've ever seen. Very atypical of a recessionary bear market. But then again, this recession has been very atypical as well. We did not expect to see the rally that we did. Absolutely not. My contemporaries at other companies, I've chatted with them, and we seem to be all in agreement that the market rally doesn't necessarily line up with the fundamentals, even the fundamentals of 2021, because nothing's proven yet. However, when you sit there and say, well, why are the markets here then? We can point to two reasons. The first one being the monetary stimulus by the Federal Reserve. When you see sharp periods of monetary inflation, so this is quantitative easing, but when it is effective, the money supply increases. So we've seen an increase in the U.S. money supply of 25% year over year, and really that's just come in the last couple months. That's not normal. Normally the money supply would grow in the mid-single digits. So that money then has found a home, and that home is the equity markets in part, right? So don't fight the Fed, or the Fed put, it's well in place today. The second aspect to the market rally is quite interesting, and it's more anecdotal. There is some evidence of it in terms of new account opening. So basically, it's the individual who's sitting at home, can't work because they've been temporarily laid off, can't bet on sports because there's no sports playing, so they're turning to the stock market as their hobby of choice. We look at this with Robinhood account openings, Schwab account openings, E-Trade, Ameritrade, all these account openings in the United States have just rocketed up, since the coronavirus. And we are seeing evidence that it's the retail investor, this euphoria or naivete that is driving the markets higher. It's easy. Like, Ron, you buy Tesla and it goes up. It seems so easy. Well, there's more to it, and we've seen this before. If anyone that has been around for a couple of decades witnessed this in 1999, when the Nasdaq was hitting new highs, and things don't make sense. Now, here's the thing that we always come back to when we see markets like this. When things go our way, all logic and reason go out the window, and so that's what's happened here. Like, don't question why we're making money. You're just making money. But there is a day of reckoning. So we don't necessarily think that the market is going to crash because valuation isn't excessive. And we do see a recovery coming. But what we perhaps have done is pulled forward returns in the last 3 months that should have taken 2 years to accumulate. And so what that means is what we have left is still positive, but we're not going to get a repeat of 40% over the next 12 to 18 months. We think it's highly unlikely. So we still like stocks, but let's be reasonable about what the return is. And we've seen this before. 1982 to 85 was a similar experience. Money supply shot up, yet bear market, strong rally of over 60%, and then the markets trended sideways to up for the next 18 months. I think that's likely what we're going to see.
Yeah, I think that's in terms of the intermediate run or the short run, maybe things might be going the opposite way. And in particular, I'm very curious about the Q2 earnings results. And so kind of my back of the envelope calculations tell me, well, if you look at the unemployment increase of 7.5% or so, and then Okun's law says for every 1% increase in unemployment, there's a 2% decrease in GDP. So it adds up to 15% GDP. And then GDP gets leverage multiplied into earnings shortfalls, and factor 3 would be typical, and you get a 45% decrease in earnings, which in fact happens to be, by coincidence, also pretty much the consensus belief of the reduction in earnings. And
I would agree with that.
A little bit more conservative, more extreme than you were thinking, I think. But
we look at some economic data that have been good forward indicators towards earnings growth, and it would suggest drops of the range being 25 to 35%. But I would not be surprised to see a 45% drop in earnings as you suggested.
And so in the short run, I'm a little bit worried about stocks, but I agree in the long run, I think the perspectives are good.
I would agree entirely. No one knows what's going to happen over the next 3 to 6 months. Seasonality tends to be weak where we are right now. Summer months aren't great for the stock market. September, October tend to be the weakest for the stock market. It would not surprise me if we saw a correction of 10 to 15% or potentially up to 20% inside of the next six months as well. So we could all be converging towards these points, Ron. I would agree with you on that.
Yeah. Some of the correction is happening today already, I think.
Yep.
Okay, so let me go on and look at some of the questions that we received, quite a few of them. So I'm not sure we can get through all of them. But so here's a question, Phillip, what are your thoughts on the effect of the real estate market in Canada during and post-COVID situation?
Certainly. Let me start by saying I'm a terrible analyst on the real estate market in Canada. I've been wrong for 10 years, thinking that we've been overvalued and due for a price correction. We haven't gotten one. So take my answer with a big grain of salt. However, given the economic conditions that we have in Canada right now, with unemployment where it is, I do think that the housing market can come under some stress. CMHC themselves have said that they expect an 18% drop in prices. I think that's fully reasonable. So I think when you see a recession like this that has come so quick, even with the interest rate or mortgage deferral programs that we have, again, it's a deferral, it's not a forgiveness, it's a deferral. You still have to pay it just at a later date. I think we're going to see the housing market come under some stress.
Okay, so let me go to a second question here that's also interesting. How do you think the debt created for the stimulus packages will be paid? And how will that affect the value of the Canadian dollar and competitiveness and ultimate living standards?
Okay, so first, everything's relative. Now, historically, governments have paid their debt in one of three ways. They default their way out of it, not very favorable, but we've seen, Argentina do that a couple of times, Russia and some other countries do that. You inflate your way out of it, again, also not very favorable, but you devalue your currency and all of a sudden your debt is worth half as much as it was. It might sound appealing, but the consequence of that is it tends to be inflation or hyperinflation, as we saw in the 1920s. Or you grow your way out of it. And in this environment, that might be a little trickier to do. I think taxes is another way, right? So I think what we're going to see is a combination of growth and taxation. Some of that might lead to inflation. In Canada, I don't think we're as bad off as what we're seeing in the United States. Our deficit as a percentage of GDP coming into this was better than the US, or one of the strongest in the world. Our overall debt loads were favorable relative to our G7 peers. So I think Canada is actually going to come out of this from a debt perspective better. The US, over the near term, what we think is, given the deficit, the massive deficit that the US is going to run, we are likely to see a weaker dollar in the US relative to Canada over the next 6 to 12 months. We think so. The DXY index is one way that we think about it. I mentioned the Canadian dollar earlier. So weaker US dollar relative to Canada, potentially some higher inflation as a result of that relative to Canada. And so the full outcome of this, I think Canada will do well. From a debt management perspective, the U.S. I think is going to be facing some headwinds.
Yeah, I was looking at these numbers, and Canada, I think, if you look at the numbers and add up Ontario as well as the federal government, it's going to amount to something like $8,000 per person in terms of extra debt accumulated due to COVID. And so, to some extent, that means if people worry about that, then they will end up saving more, which means they're going to be needing investment advice. So that's one good thing. But on the other hand, that'll also cause a reduction in demand, which might eventually be our big problem going forward.
Exactly. It becomes a double-edged sword. Right? You need that growth. You need demand to increase in order to have the economic gains to raise the tax revenues to pay off the debt. It can't just be austerity.
Mm-hmm. So yeah, that's definitely an important question and an interesting one. Okay, let me see. Here's one question. Any suggestions about emerging markets to watch for? Do you have an idea about that?
Yeah, so actually we're quite favorable on the emerging markets. Now, when we talk about the emerging markets, let's define them in two different ways, because the emerging market index, 70% of that index is Asia related. So China, Hong Kong, South Korea, Taiwan. And then 30% it tends to be dominated by Latin America or commodity related economies. As we look forward, right, we actually think that the emerging markets are quite favorable. So here we can see, you mentioned higher oil prices, but I think we can see higher prices for base metals as well. We're seeing it for copper. Copper's started to move up. I think as we shift into an global economic recovery, demand for base metals will go higher, prices will go higher. That should benefit these commodity-related economies. And then Asia, from just the management of the coronavirus, it seems that they've done a better job. They're opening up faster. I think their economies are going to recover quicker. And then from a valuation perspective, they're cheap. They're attractively valued. So we like the emerging markets right now.
Okay. So yeah, they've gone through kind of a bad time, and maybe now the time has come.
Yeah, and with a weaker dollar, if we're right on the weaker U.S. dollar, that always tends to benefit emerging markets as well.
Interesting. Okay, let me look at the next question. Okay, this is a question by Pam Pringle, and she asks, given the global move to renewable energy, do you see Canada moving in that same direction so that the dollar is not as affected by changes in oil prices? So that's diversification, I guess, for the Canadian economy.
Yes. Over the long term, yes, I think that will be the case. But when we've looked at the adoption of electric vehicles, just the production of electric vehicles and the adoption of electric vehicles, we are decades away from making a meaningful impact on oil demand. And then remember that it's slightly less than half of a barrel of oil actually goes towards gasoline. So the rest of it is in other types of fuels, but also clothing, cosmetics, things like that. So it will be quite a while before the global demand for oil is actually in steady decline, and Canada will have to shift to some other export. Now, one of the reasons why we are a petrocurrency is because petroleum-based products, oil and otherwise, are a significant segment of our exports to the United States, and therefore they're priced in U.S. dollars, produced in Canadian dollars. There's always that exchange demand, and that's why as oil prices go up, we have more U.S. dollars to sell for Canadian dollars. That creates demand for Canadian dollars, pushes it higher.
Yeah. Okay, so let's see the next question. Okay, and here somebody is asking about deflation risks. We haven't talked about that, but that's potentially an important issue. And specifically deflation spiral risks in the US and Canada. Do you see any of that?
We're more of the mind that we're going to see inflation. There's higher inflation risks than deflation risks. Again, part of it is just an increase in the money supply. Part of it is a base effect. So on year over year, our inflation models would suggest that we're going to see higher inflation into 2021 just because wages are down, rents are down, oil is down. That might only be temporary, but a kind of a deflationary spiral that we see in Japan, we would say that's more demographic, than economic, and that's just the aging of the Japanese population and the fact that their population is shrinking. Right, a shrinking population, less economic growth. That will lead to deflation. In the U.S. and Canada, we don't think that's the case. We think it's less likely that we would see deflation. The greater risk we think over the next 12 to 24 months is higher inflation.
Okay. Yeah. So you would probably disagree with Div Macklем's perspective that supply is going to be picking up very quickly, but demand will not. So in that case, you're going to really have a negative effect on prices from that.
You could, but I think supply, if we have to work down our inventories first, right? We've got an inventory overhang. Before you start really ramping up the manufacturing, we've got to work off the inventory that we have, and new orders have to come in order to give a business the confidence to flip the switch and get manufacturing going. So, yeah, I don't necessarily agree that. I think supply can come on faster than demand, but I don't think it necessarily will.
Mm-hmm. Okay. That'll be an interesting issue to watch for. Yeah. Okay. So we've got time for one more question, I think. Okay, so here's maybe a personal question. Not sure if you'd like to address that, but question is, what are your personal investment holdings, if you're comfortable to share those?
Sure. I have no problem sharing that at all. So I kind of eat my own cooking. So we have a model portfolio, my team, that we manage and update on a quarterly basis. And my personal portfolio is pretty much right in line with that one. So currently it is 55% equities, 45% fixed income. Now, I will be increasing my equity weight at the end of June, so at the end of this month, when we rebalance and make any shifts, back to a 60-40 neutral asset allocation. The breakdown is going to be the 60% equity is 10% Canada, 50% global. So I do favor global over Canada. The 40% fixed income is actually 15% high yield bonds. So corporate high yield, which I think is very favorable right now. And then 25% is core bonds. Now, within that, I should say, I do have a small piece of gold in the overall portfolio. I do think gold goes higher with monetary inflation. Gold can go higher, and we think it's trying to break above $1,800 an ounce today. I think it could get to $2,100 an ounce based on the current M2. So I do think there's an upward bias for gold. That would be the bulk of my portfolio makeup like that. Now let me just explain why, though, because some people say, well, why 60-40? You have a long-term time horizon. It's because the work that we've done has shown that a 60-40 portfolio, which is our benchmark now, I move around that. And sometimes I've been 80% equity, sometimes I've been 50% equity. So it depends on the opportunity set, as we've discussed. But the benchmark tends to be 60-40 because historically that works. Historically, that's delivered equity-like returns with much less volatility, right? And I believe this even into retirement. There was a question I did see earlier saying, how would a retiree invest? Our work would suggest, now the old belief, the old thought was you reduce your equity weight into retirement. And it basically was a 100 minus your age. That's what you should own in equities. I don't believe in that at all. I think that is incorrect, because what that is doing in this environment is increasing your probability of shortfall, or that you're going to run out of money. Now, obviously, it depends on how much capital you have, but that's one of the risks. In this low interest rate environment, we are not going to be able to generate the returns out of bonds like perhaps we planned 30 years ago, when bonds were yielding 6 to 9%. It's much lower than that today. So our work would show that even in retirement, a 60-40 portfolio is ideal in order to continue to maintain your standard of living. And we're using average Canadian data for that. So that's how my portfolio is invested, and that's how I'm likely to be invested over the long term.
All right, well, fascinating. We could probably talk about this for a few more hours. So thank you very much, Phillip. And let me now hand over to Sue McCracken for some final comments. Go ahead, Sue.
Wow, that was great. Thank you so much, Phillip and Ron, for a very interesting session. I think we all learned something and some great advice there, Phillip. So thank you so much for sharing your insights with us. I think the number of people that are participating in these sessions is really exciting for us here at DeGroote. So thank you. I hope you found it valuable, and I hope you will join us again. So if you are interested in other seminars, other webinars, other knowledge labs we're hosting, please keep an eye on your email and watch for those future emails that we'll be inviting you. So thank you again for joining us today. Stay healthy, stay safe, and we hope to see you soon. Thanks so much, everyone.